Explanation. The CAGE PESTEL weighted scoring model combines two classic screening tools. CAGE looks at cultural, administrative, geographic, and economic distance between the home country and a target emerging market. PESTEL adds political, economic, social, technological, environmental, and legal factors. Step by step. 1. List all candidate countries, for example Brazil, Vietnam, Kenya. 2. For each CAGE dimension assign a sub-score 0 to 10. For culture, a 0 means very similar, 10 means very different. 3. Do the same for each PESTEL factor, for example political stability, tax rate. 4. Give each dimension a weight that reflects its importance for your industry. For example, a tech firm may give technology a weight of 0.25, while a consumer goods firm may give cultural a weight of 0.20. 5. Compute a total weighted score for each country. Score I equals the sum from j equals 1 to n of w sub j times s sub ij, where w sub j is the weight of factor j, and s sub ij is the sub-score of country I on factor j. 6. Rank countries from lowest, most attractive to highest. Analogy: imagine you are buying a car. CAGE is like looking at the car's size, fuel type, and brand origin. PESTEL is checking the road conditions, insurance cost, and future regulations. The weighted score tells you which car market combo gives the best overall fit. Explanation. The entry mode decision matrix compares 4 common ways to get into an emerging market: joint venture, greenfield investment, merger and acquisition, and licensing. For each mode you estimate payoffs on 2 dimensions: strategic fit, how well it matches long-term goals, and financial return, expected net profit. Create a 2x2 payoff table for each mode. Mode strategic fit 0 to 10, financial return net present value in $1 million. Joint venture 7, $45 million. Greenfield 9, $38 million. Merger and acquisition 8, $52 million. Licensing 5, $20 million. Next, build a comparative payoff matrix where you assign a weight to each dimension. For example, strategic fit equals 0.4, financial return equals 0.6, and compute an overall score. Overall sub K equals 0.4 times fit sub K plus 0.6 times NPV sub K divided by max NPV. The mode with the highest overall score is the preferred entry route. Real-world example: a US solar panel maker wanted to enter India. The joint venture with a local firm scored high on fit, access to distribution, and decent NPV, while a greenfield plant gave the best strategic control but a lower short-term NPV. The matrix helped decide on the joint venture as the balanced choice. Monte Carlo simulation treats uncertain risk factors as random variables and runs thousands of what-if scenarios to see how they affect project value. In emerging markets, 3 key risks are: political risk, e.g. regime change, expropriation, modeled with a probability distribution of a risk premium rho sub-pol. Currency risk, modeled by a stochastic exchange rate process, often a geometric Brownian motion ds equals mu sdt plus sigma sdw. Operational risk variability, in cost overruns represented by a normal distribution with mean mu sub-op, and standard deviation sigma sub-op. For each simulation run, you draw a random draw for each risk factor. Adjust the cash flow forecast CFT star equals CFT times 1 minus rho sub-pol times 1 over ST plus operational shock. Compute a risk-adjusted discount rate RADR. R sub RADR equals R sub risk-free plus beta times ERP plus rho sub-pol plus rho sub-cur plus rho sub-op. Calculate NPV for that scenario. After 10,000 runs, you obtain a distribution of NPVs. The mean gives the expected value, while the 5th percentile can be used as a conservative decision rule. Analogy: think of forecasting the weather. Instead of giving one temperature, you run many simulations of clouds, wind, and sun, then look at the range of possible outcomes. The same idea helps you see the range of possible investment returns. The output is a histogram of NPVs, and a value at risk va R metric, e.g. 20% chance the NPV falls below $30 million. This quantitative view guides mitigation strategies such as political risk insurance or hedging currency exposure. Financial modeling in emerging markets starts with standard discounted cash flow tools and adds layers for flexibility. 1. NPV and IRRs. NPV formula equals sum from T equals 0 to T of C F T divided by 1 plus R raised to T. IRR is the discount rate R that makes NPV equal 0. Solve iteratively or with spreadsheet function IRR. Example, a $100 million greenfield plant expects cash flows of $30 million per year for 5 years. With a cost of capital of 12%, NPV equals 30 million divided by 1.12 plus 30 million divided by 1.12 squared plus minus 100 million equals $23.9 million. 2. Real option valuation. Emerging markets create optionality. You can expand, abandon, or delay. Stage 1 now, invest $100 million as cost. Stage 2 after 2 years. If market growth greater than 8% with probability P, make a follow-on investment of $40 million and capture extra cash flow of $20 million per year for 3 more years. Step A. Calculate NPV of the expansion branch using the same discount rate. Step B. Multiply by probability P. Step C. Add to the base case NPV. The option adds value because it captures upside while limiting downside. 3. Decision tree example. Decision table. No entry probability 3/10 cash flow 0. Entry no expansion probability 5/10 NPV 23.9 million. Entry plus expansion probability 2/10 NPV 38.9 million. Expected project value equals 0.3 times 0 plus 0.5 times 23.9 plus 0.2 times 38.9 equals $21.2 million. The real option component often turns a marginally attractive NPV into a clearly favorable investment when the market is volatile, which is typical for emerging economies. Explanation: competitive positioning blends Porter's 5 forces with the BCG growth share matrix, both adapted for emerging market nuances. Porter adapted. Threat of new entrants higher in emerging markets because barriers regulations capital are often lower. Assign a score 1 to 5. Bargaining power of suppliers may be high if local inputs are scarce. Adjust score. Bargaining power of buyers in price-sensitive markets, buyer power rises. Threat of substitutes, consider informal sector substitutes e.g. street vendors. Industry rivalry, often fragmented many small players. Create a force scorecard weight sum to 1 and compute an overall industry attractiveness index. BCG matrix with market share growth. Relative market share RMS equals your sales divided by largest competitor sales. Market growth rate G equals annual % growth of the total market. Place the business unit in. Stars high RMS high G invest heavily. Cash cows high RMS low G harvest. Question marks low RMS high G decide to invest or divest. Dogs low RMS low G consider exit. Example: a French dairy firm entering Kenya. RMS equals 0.35, largest local dairy has 30% market. G equals 12% Kenyan dairy market growing fast. Falls in question marks. The firm must decide whether to build a greenfield plant increase RMS or partner with a local co-op. By combining the four-score industry attractiveness with the BCG position managers, can prioritize resources to the most promising market segment and entry mode combos. Institutional and regulatory analysis quantifies how WTO rules, local incentives, and legal barriers affect the net benefit of a project. Step-by-step cost-benefit model. 1. Base benefit B0, projected cash flows without any regulatory adjustments. 2. WTO compliance cost, CW, tariffs, standards, and intellectual property requirements, often a percentage of revenue. CW equals alpha times revenue. 3. Local incentives, IL, tax holidays, subsidies, or infrastructure grants, treated as a cash inflow. IL equals beta times investment. 4. Legal barrier cost, CLB, licensing fees, bureaucracy time cost, or risk of expropriation, modeled as a fixed amount plus a probability factor. CLB equals gamma plus delta times P expro. 5. Net benefit NB. NB equals B0 minus CW plus IL minus CLB. If NB is greater than 0 and exceeds the required hurdle rate, the project passes the regulatory filter. Numerical example. Projected 5-year revenue equals $200 million. B0 equals $80 million after operating costs. WTO tariff equals 5%. CW equals 0.05 times 200 equals $10 million. Government offers a tax holiday worth 8% of capital investment, $120 million. IL equals 0.08 times 120 equals $9.6 million. Legal fees equal $2 million. Probability of unexpected regulation equals 0.1 with impact $5 million. CLB equals 2 plus 0.1 times 5 equals $2.5 million. Net benefit equals 80 million minus 10 million plus 9.6 million minus 2.5 million equals 77.1 million. This systematic formula helps managers compare countries with different incentive packages and compliance burdens on an apples-to-apples basis. Analogy: think of buying a house. The price is the base cost, but you also have to pay property tax, WTO cost, may get a seller's discount incentive, and might spend on renovations because of local building codes, legal barriers. Adding and subtracting these gives the true amount you'll pay. A balanced scorecard for emerging markets translates strategy into measurable performance across 4 perspectives: financial, customer, internal process, and learning and growth. Each perspective gets key performance indicators with assigned weights that sum to 1. Overall score equals the sum for P from 1 to 4 of W sub P times the inner sum for K from 1 to N sub P of W sub PK times actual sub PK divided by target sub PK. Where W sub P is the weight of perspective P, for example financial equals 0.35. W sub PK is the weight of KPI K within perspective P, for example return on investment equals 0.6 in financial. Actual sub PK and target sub PK are the actual and target values. Example key performance indicators for a consumer goods firm entering Brazil. Financial: return on investment, net profit margin. Customer market share, net promoter score. Internal process: lead time reduction, % of local sourcing. Learning and growth: employee training hours, innovation index. Suppose the firm achieves 90% of return on investment target, 80% of market share target, 70% of lead time target, and 100% of training target. Plugging into the formula yields an overall score of 0.84 on a 0 to 1 scale. Management can set a threshold, for example overall score greater than or equal to 0.80 to deem the market entry successful. A strategic control loop. Plan, define targets and weights. Measure, collect key performance indicator data each quarter. Analyze, compute overall score and drill down to low-scoring key performance indicators. Adjust, reallocate resources, for example increase local supplier development to improve scores. The balanced scorecard thus turns high-level strategy into a numeric dashboard that can be tracked even in volatile emerging market environments. Explanation: ESG scoring quantifies a firm's environmental, social, and governance performance on a 0 to 100 scale. In emerging markets, the score can influence the cost of capital because investors demand a premium for low ESG firms. Stepwise ESG impact model. Compute individual pillar scores E, S, G using publicly disclosed data, for example carbon emissions, per unit labor rights violations, board independence. Aggregate to an overall ESG score ESG total by weighted average, commonly 1/3 each. ESG total equals E plus S plus G divided by 3. Translate ESG total into an ESG premium lambda ESG using a linear or exponential function, a simple linear rule. Lambda ESG equals lambda max times 1 minus ESG total divided by 100. Where lambda max is the maximum premium, for example 3%. Adjust the base cost of capital R base. R COSI equals R base plus lambda ESG. Numerical illustration. Base cost of capital for a comparable firm in Mexico equals 10%. ESG scores E equals 70, S equals 55, G equals 65, resulting in ESG total equals 63. Assume lambda max equals 3%. ESG premium equals 3% times 1 minus 0.63 equals 1.11%. Adjusted cost of capital equals 10% plus 1.11% equals 11.11%. A higher ESG score, for example 85, would cut the premium to 0.45%, lowering cost of capital to 10.45% and improving NPV. Real-world analogy: think of buying a car with a good safety rating. Insurance companies charge lower premiums because the risk of an accident is lower. Similarly, investors insure themselves with a lower required return when a firm scores well on ESG. In practice, firms can run sensitivity analysis, vary ESG total by plus or minus 10 points, and observe the effect on NPV. This quantifies the financial upside of improved